You know how when your homework gives you like a whole bunch of stuff and you look at it and you're like, I don't even know where to start? Well, we're going to take a homework problem. This one happens to be at the intermediate accounting level, but the same process would work for financial accounting, also known as principles of accounting. So in this case, we're going to take a homework problem where they give you a whole list of accounts and they're like, make this into a balance sheet. So we're going to walk through that, and you can see that the preparation part of it is the key to the whole thing. So let's take a look at a couple of different problems. The first one, XYZ Company's balance sheet accounts and amounts as of December 31st, year 3, are shown in random order as follows. Now, sometimes they'll give it to you in random order, sometimes they'll do it in alphabetical order, but it doesn't matter because you know your stuff. And if you don't, you're going to be much stronger by the end of this video. So let's dig into this. So what we've got here is all of these different accounts and their balances. Now you'll see some of those balances are negative. Well, they're saying that if this is a negative value, right here they're telling you that if it's in parentheses or it's a negative value, it is a credit balance, okay? That's the first thing. Then they go on to give you all of these different accounts. So here's the way to break this down in a way that makes this a whole lot easier. Before you even start to think about the balance sheet and putting the numbers and the accounts and all of that stuff, we're going to start with the prep work that's going to make that a lot easier. You ready? So what we've got to do is we've got to go through each one of these accounts and we've got to figure out what type of an account it is, because the type of account is the place that it's going to go on the balance sheet. So on the balance sheet, we're going to have assets, liabilities, and equity. So this first account, there's a clue here. It has payable in its name. Anytime it's a payable, it's a liability. So because this is a classified balance sheet, we're not just going to throw all of our liabilities together in one spot. We're going to break things out. So we're going to take our assets, we're going to divide those into current assets, property, plant, and equipment assets, and if it's appropriate, intangible assets. For our liabilities, we're going to divide those into current liabilities and long-term liabilities. And then for our equity accounts, we're going to separate those into contributed capital and earned capital. Hang on, I got you. Let's go to this first one, income taxes payable. Well, we said if it's payable, it's a liability, but is it a current liability or a long-term liability? This is where you have to think things through. Is the IRS going to wait for a long time for you to pay your taxes? No, they're not. So we're going to call this a current liability. We're going to throw that right up there. Prepaid items. So prepaid items are things like prepaid insurance, prepaid rent. We've had this before where we said that a prepaid item is going to be an asset. But is it a short-term current asset or is it a long-term asset? Well, a prepaid item we said is something like prepaid insurance. So if we're going to use up that asset within a year, and let's say we paid 12 months worth of insurance, we're going to use that up in a year. So we say, okay, that's going to be under the current asset part of our balance sheet. Okay. Additional paid-in capital on common stock. Common stock is the clue. Common stock is an equity account. This is the amount that is above and beyond the par value of that stock. It's what we actually sold it for. So we want to call that an equity account. But is it contributed or earned equity? Well, if it's contributed, that means somebody's putting money into the business, okay? So this is common stock. Remember way back when we had the transaction where we said so-and-so put money into the business in exchange for common stock? That's what we're talking about here. We're talking about an investment into the business. So if our balance sheet asks us to put this into a category, we're going to put this into contributed capital in our equity section. Okay, and then we have land. Is land a current asset? No, land is something you're going to hold on to for a long time. So we're going to put that into our long-term asset which might also be called fixed asset and might also be called property, plant, and equipment, depending on what your textbook is calling it. Okay, notes payable. It's payable, so we know that it is a liability, but is it a current liability, one we're going to pay within the next 12 months, or is it a long-term liability? Well, it says here that it is due in year 7. So year 7 tells us that it is beyond a year. So that liability is going to be a long-term liability. We're going to put it in the long-term liability section of our balance sheet. Now we've got a notes receivable. If it's receivable, we're going to get it, then it's an asset. Somebody else has the money right now, but it's our money and we're going to get that. So this says it's a notes receivable. Receivable is an asset, but is it a current asset or a long-term asset? Well, it says it's due in year 5. So we're going to put that into our long-term asset section. Accounts receivable, we said that's a receivable. It's an asset. Accounts receivable, we're not going to wait 5 years for our customers to pay us. So we're going to put that into our current asset section. Premium on bonds payable. Okay, that's a tricky one. So anything related to bonds payable is going to go in the liability section because it's a payable. But this one is trickier because a premium on bonds payable means that our liability is worth more on our books. So this is an adjunct account. We're adding on to the value of that liability. So we're going to call that one an adjunct liability. Now, accounts payable, we said accounts payable, we need to pay that within usually 30 days. So that is a current liability. Now you could go through here right now and say, okay, are there any other payables? Well, here's a wages payable. Let's categorize that as a current liability. Okay, we've got bonds payable. Well, bonds payable we said was a long term. It's due in year 6. So we're going to pop that into the long-term liability section. Now we've got a sinking fund to retire bonds payable. Holy moly, it has payable in the name, so it must be a liability, except that it's not, because the important part is not the bonds payable part, it's the sinking fund. So a fund means that it's an asset. And what you're doing with a sinking fund is you are putting money away to pay for that bond payable when it comes time for you to pay it back. So this is like if you're saving for a roof on your house, you've got a sinking fund for that roof. So you're going to put a little bit away every month to go towards that new roof. So in this case, what we're doing is we don't have a liability, we actually have an asset. So we're going to put that into a current asset classification, but we're going to check on that one. Okay, so now we've taken care of any of the payable ones. Let's come back here and look at inventory. So inventory is an asset. Is it a long-term asset? Well, it's not our intent to hold on to inventory for a long period of time. We want to turn that inventory into cash. So inventory is a current asset. So we're going to put that in that category. Now let's talk about accumulated depreciation. That's also a tricky one. So accumulated depreciation is like a sub-account for our property, plant, and equipment or fixed assets. So we're going to have our historical cost, what we paid for that asset, in its own account, and then we're going to keep track of the accumulated depreciation that goes along with that in a sub-account. And that sub-account is a contra asset. It works the opposite of a regular asset. So in the description, I'm going to drop my Contra account video so that you can check that out if you need to review that. Okay, so let's talk about patents. What is a patent? It is something that is of value to the company owns it and uses it to make money. So a patent is an asset. Well, is it a short-term current asset? No, it's something that we're going to be having for a long time. But is it a fixed asset? It's actually an intangible asset. So we're going to put that here. It's intangible because we can't walk up to it and kick it in the tire. All right, and then let's look at the next one, equipment. Equipment is a long-term asset. So we're going to categorize that in our long-term asset, fixed asset, property, plant, and equipment, whatever this company is calling it. Well, let's see what else we've got here. We've got additional paid-in capital on preferred. Preferred what? Preferred stock. So stock is what kind of an account? It's an equity. Is it contributed or earned? It's definitely contributed. So we're going to pop that up there. It's an equity account and it's a contributed equity. Okay, allowance for doubtful accounts. Remember over here when we talked about accumulated depreciation being a contra asset? Allowance for doubtful accounts is the same, but goes along with an asset account. It goes along with accounts receivable. So this is a contra asset. So we're going to pop that in there. All right, buildings. Are buildings a short-term asset? No, they're a long-term fixed asset, property, plant, and equipment. So we're going to pop that over there. Advances from customers, long-term. Okay, so when we get money in advance, which is what's happening here, we haven't earned that revenue yet. So our customer is giving us a deposit. They want us to build a house for them or deliver some kind of service, but we haven't done that yet. So we're going to set this up as a liability that we are then going to, at some point in time, do an adjusting journal entry that's going to move it out of this liability and into earned revenue. So normally that would be a short-term liability. You would be delivering that service or that product within a short period of time. In this case, it is saying specifically it is a long-term customer deposit. So we need to put that then into our long-term liability section. All right, then we have cash. Cash is an asset. It is a current asset because it's as close to cash as you can get it to be. So we're going to put that in the current assets section. Now we've got accumulated depreciation for the equipment. Well, this is going to be the same thing as we had over here for our accumulated depreciation for our building. So it's going to be a contra asset. Then we come to retained earnings. Okay, retained earnings is all of the profits and losses a business has accrued over time. Okay, equity. And because this is coming from the business earning money, this is not somebody putting money in, this is the business generating its own money, we're going to put that into earned equity. So retained earnings is earned equity. And then we have preferred stock. Well, preferred stock is equity, and we've already said that that would be people paying in money, so it's contributed equity. And then common stock is also going to be contributed equity. Okay, so we have categorized all of those accounts. Let's go over and look at another one because it's got some additional accounts in it that I wanted to talk about. So we've got accounts payable, receivable, our depreciation. We have something called accumulated other comprehensive income. Now, accounting scholars will recognize the word income and immediately think, well, that doesn't go on the balance sheet because that's revenue. So if you have a question about an account like that, there's this really awesome resource. You can come over here and you can Google what type of account is accumulated other comprehensive income. And look right here, it's an equity account. So we would assign that to our equity section. We've got our bonds payable. That is a payable, so it's a liability, but it's due in year 12. That's a long-term one. And then the other ones are similar until we get here to marketable securities short-term. So a marketable security would be, well, think about it in terms of like a certificate of deposit. It's something that you're going to have for 90 days or 12 months, and then it's going to become cash again. So this is an asset. It's a current asset. Trademarks are another example of an intangible asset, so that would go in the intangible section. But look at this right here. Revenues and salaries expense. Do you think maybe they're trying to trick you? Yes, they are. What they're trying to do is say, oh, does this person know that revenue and expenses doesn't go on the balance sheet? Let's test it out and see. So revenues and expenses would go on the income statement. We're not doing an income statement. We're doing a balance sheet. Don't try to mess with us, textbook. So once you have all of those things categorized as to what type of account they are, then it's a matter of filling in the balance sheet. So what you need then is you need an example of a balance sheet so that you can follow along in the homework. Now, if it's a textbook homework platform, they're probably going to give you the format. They're going to say, put your assets here, put your liabilities here. And they're going to give you choices that you can choose from as to what goes in that spot. But if you go to your textbook, it's going to give you an example that's going to be very much like what you're seeing in the homework. They're related. I don't know if you knew that. What's in the textbook is in the homework. What's in the homework is in the textbook. There's a tip for you. So the number one thing is to go through and categorize those accounts so that you know where to put them and you're not fumbling around. It gets things done a lot more quickly if you do that first. I hope that helped. I will see you in another video.